We expect monetary policies of central banks to have a significant impact on global growth and financial markets. While asset prices may receive a further boost from abundant liquidity in our view, divergent policies are likely to increase volatility across asset classes. We remain moderately positive on risk assets, but believe a selective and cautious approach is required due to several geopolitical risks and stretched valuations in some markets. We highlight three interesting themes which could benefit against this backdrop. In our view, improving labor market conditions and expectations for a pickup in US inflation supports the possibility of a rate hike in 2015. Despite this, we believe that the investment case for longer maturities in the US is still strong, in spite of the high valuations. We expect these to be less impacted by rate volatility and more linked to potential growth and inflation expectations in the US. A relative value yield curve strategy may benefit against this backdrop of a flattening of the US yield curve. More generally, we prefer sovereign debt in the Eurozone, where low yields, benign inflation, and abundant liquidity driven by the European Central Bank's quantitative easing program may provide fundamental support for the asset class. Within the Eurozone, we prefer peripheral bonds, where we believe the yield pickup is more interesting over core Eurozone bonds. Moreover, peripheral bonds could benefit from yield compression. We are also positive on long-dated German bonds, which are supported by strong technical demand. We continue to favor European equity markets over US equity markets on the basis of relatively more attractive valuations and a weaker euro. Low oil prices impact both markets positively, but tighter labor markets may put pressure on margins through higher wages in the US. On the other hand, strong earnings growth could drive the European equities market higher in 2015 in our view. European equities have enjoyed a strong upside since the announcement of the quantitative easing program by the European Central Bank. Flows have picked up considerably in 2015, and we question whether this has become a consensus long trade. Bottom-up opportunities may be more appealing against this backdrop in our view. One such opportunity could be the recent pickup in share buyback activity among cash-rich European corporates. Approximately $8 billion worth of buybacks have been announced by a few European companies in January and February, including budget airline Ryanair and Dutch semiconductor equipment supplier ASML Holdings. We also hold a positive view on the Japanese equity market, particularly relative to other equity markets, on the basis of attractive valuations and positive earnings momentum, driven in part by lower oil prices and a weaker yen. Consumer-related themes, such as within retail and transportation sectors, may enjoy an earnings boost as the economy continues to strengthen, while industrial names such as automation themes may benefit from an improving global economic cycle. A technical support for the Japanese equity market comes from the country's $1 trillion plus pension fund, which many expect to increase its allocation to domestic equities to approximately 25%. Sectors such as real estate and banks could benefit amidst greater liquidity and cheap valuations. One of the most interesting dynamics we are witnessing in Japan is a cultural change among cash-rich corporates to become more shareholder-friendly. Retained earnings are very high, exceeding 60% of GDP, and we expect companies to boost dividends and engage in more share buyback activity, as already witnessed last year. In conclusion, while we maintain our conviction on risk assets, we believe that selectivity is key in an environment of rising risks and rich valuations in some markets. Selective hedges may also help against a more volatile backdrop. Thanks for listening in, and please tune in to our next quarterly review.